right, Event Trader breaking in here. I'm going to be joined shortly by Brett, and in addition, I think Scott might come in for a quick second here for his discussion. Is that Brett?
Yeah, howdy.
Doing good, Brett. How are you doing today?
Doing pretty good.
Hey, so wanted to ask you a quick question and just a quick stock question for your opinion. What do you think of this Amazon chart right here in this move? You got any thoughts on that? Brett?
Well, yeah, I'm here. I'm looking at it right now. Yeah.
Sorry.
I mean, are we talking intraday or are we talking long term?
Well, long term, and certainly this intraday move seems to be breaking some longer term support levels here, right? So I'm just curious as how you're looking at this chart. Because I think obviously it plays a pretty big role in a lot of ETFs and indices, obviously.
Sure. My correction target would be 1325.
Okay. Which isn't all that far away, really.
No, another 100 points.
Okay. All right.
That is that. I wanted to take out the low that preceded the prior directional rally. So you saw a pullback in the February March correction.
Right.
Its primary low was that 1350 area. I wanted to overshoot and take that out and run orders underneath that, and then we would have done the work that needs to be done. That's kind of like a, from an Elliott perspective, sort of like a wave 4 base area, and we saw the final wave of the principal rally for this cycle top just above 2,000. So this initial decline would probably strike down and run through that level and find support underneath it after an overshoot.
All right, so there you have it. Okay, Brett, let's break into the Fed here. We've talked about how it's good to always kind of wait and get a little perspective to see exactly what's going on in the markets and what the reaction is to the Fed. And here we are just kind of bleeding to fresh session lows at the moment. Haven't really seen any sort of a bounce. And, obviously there's a lot of concern around Fed policy misstep, as we're seeing evidence in this move here. And I was kind of surprised to see how much focus has been on the balance sheet. Now, from my perspective, I think a lot of it just had to do with that happened to be the straw that broke the camel's back rather than the real driver.
Definitely, yes.
So, well, I won't talk too much more about it. Then I'll let you give your basic thoughts on what you see playing out here.
I just think it was a feeling that there's something that the market sees going wrong here that it gradually came to understand that the Fed does not see. And I'm not sure whether it's because Powell kind of seems to approach his job almost like a CEO rather than like a committee chair. He on retrospect, as I think back about it, it almost seemed like he was trying to, give a tough love talk from a CEO to inspire confidence that everything is fine and all these naysayers are crazy and we're doing great kind of thing. And so it's really tough to know what he really thinks about the situation, whether he really is sitting there thinking, we may need to shift gears here, but I don't want to signal to the market that we're seeing poor data to confirm its fears. I think it's a possible theory on it, but either way, the market wants a committee chair, not a CEO. The market wants a responsive countercyclical mechanism if things are starting to deteriorate to prevent it from escalating. Because wrapped up in all of this, like I've tried to suggest a number of times, cyclicality it's not like the economy and the markets are two completely independent things. All of it is attached to a shift in a sort of collective psychological process, an evolutionary process over the course of the cycle. And I like to think of it as being on a spectrum from risk aversion on one end to risk assumption on the other end. And I think that the market is seeing that the run-up into the fiscal stimulus and earlier this year was a process of getting everybody in markets and in the economy kind of wrong-footed in the direction of the extreme end of the spectrum on risk assumption. And now it's a process of deterioration. And to me, what's going on here is valid that the market is seeing, and that we're seeing it being discounted right now. The idea that the Fed should be far more responsive, far quicker at this point, because we are seeing a genuine deterioration. Even though from the standpoint of the other view on Powell is I think maybe he's a staunch what I'll call a quantitative empiricist, and he's going to wait to see data that confirms things when what's shifting is not going to show up in the data until well after we've locked in a path progression that's changed in a negative way. And I think the market sees that. You're not going to see clear macroeconomic indications of a deterioration until after it's too late to stop. And I think the market sees that. So I think what's happening is a cycle-ending kind of process here, and we are. It's going to be interesting to see. The other thing that I would bring up is that the market's going to be more nervous about a monetary policy error just because the fiscal book is wrecked, right? There's.
What do you mean
it's
by
only
that?
the Fed. We're coming into a situation where we've got the worst fiscal situation as a country that we've ever had next year.
Okay.
But, yeah, I mean,
Just
right? There's not going to be any room
issuance.
for. You understand what I'm saying? There's not going to be any room for fiscal stimulus, and we've got political gridlock, which will prevent it anyway. So we're going to have the Treasury doing $1 trillion in supply. The Fed balance sheet's going to continue to compete with that, so that is an issue for the Fed balance sheet. So you've got $1.5 trillion of Treasury supply coming. There's no way that we're going to be able to fund some big fiscal stimulus that's going to help monetary policy if the Fed is sitting there, like let's say the White House thinks, oh, this is deteriorating, we need to support things.
Right,
they're not have any room to do that, and the Dems in the House won't let them.
Right. Yeah, I mean, I'd agree with that. And unless it was filled with pork that the Democrats could get on board with, which is, I guess, the only really way that you could go about. But that doesn't seem like a direction that the GOP would want to go in. It'd have to be.
You know what? The Dems are going to probably, want this to be a troubling time into campaigning for the next election.
Sure.
Like, that's the surest way to guarantee that this administration doesn't continue in place.
Yeah, I mean, just trying to drive the car off the cliff so that they could win 2020.
And it'll be Trump's car. There's no doubt about that.
So, now the question, of course, comes into play. Like, personally, I think that the president was happy to see this kind of reaction because that gives him a little bit more leeway in saying, hey, it's the Fed, not me. And, when we get market reactions like we did yesterday, it gives them a little bit of powder there, at least on the campaign trail anyway. So
I think a little bit, but I think that it's going to be tough for them to sell that the Fed's doing something egregious.
Correct.
Here. It's not egregious. It's not like they hiked by 50 basis points and then hiked again by 50 basis points right in the middle of a crash. They did something that they'd said they would do, and they are slowing down. And we do have macroeconomic data that still suggests we're in an expansion. We do have, all sorts of data right now that can point to a justified move on their part. But I think it would have been an extraordinary Fed, I think, to be as proactive as I think the market wants them to be. But I think, again, it's because we're walking into a situation that is very identifiable as problematic. It's not just about the data we have right now. It's about the comparisons that we're going to have and the process that is starting where people are starting to tighten up in a situation where there's going to be absolutely no fiscal supports and a lot of political handcuffs. And, it's just there's very foreseeable problems that we need to be kind of prepared for, and it doesn't seem like a pure quantitative empiricist is going to be forward-looking enough to guide through that problem.
Yeah, I mean, certainly it's amazing to see. And I was kind of interested to see the Philly Fed this morning too. I don't know if you had a chance to take a look at that.
Yeah, 9.4, I think, wasn't it?
Yeah, it was 9.4, but and it was the lowest reading since August of 2016.
Yep.
But the interesting thing that had caught my eye was that when you actually read it, it didn't sound as bad. I put some of the primary comments up in it, and I don't know, the number just didn't seem to match up with the language, and it was my take from it, which I thought was kind of interesting.
Okay, well, that's interesting. I don't think I've ever read a Philly Fed, so that's. I mean, you're talking about are you talking about? Is it like citations from like purchasing managers of businesses?
Yeah, exactly.
What they expect?
Yeah. So
things are good. We're doing a lot, but then the number doesn't come in that great.
Yeah. Hey, quick look, Brett. What do you think of this little move here in the J&K and HYG? As we see a little bit of a bounce in the markets.
Yeah. I mean, everything is we're loaded for a spring.
Yeah.
Yeah. I mean, like I mentioned earlier, I wanted to short where you shorted. I guess I wanted to short so bad earlier. And I just, there's no way I was going to pull that trigger with 1.75 on the put call just based on, the rules that have served me well over the years. But it was painful to watch this decline go. But at the same time, I know the problem with that for me in that position is I'm going to have no conviction in it. Every time there's a little uptick, I'm going to be like, oh, here comes the face-ripping squeeze, because it's got to happen.
Right.
At some point to relieve this pressure. It's like if you had humidity at 150% and no rain. Eventually it's going to break through and start to rain. The squeeze is kind of like the rain. And it'll be interesting to see how much we get. Are there any headlines attached to this? Because the market's...
Mnuchin's talking right now. I mean, he did say something about seeing rebalancing out of bonds and equities, but I mean, I don't know. I wouldn't be... that's kind of a throwaway. He's talking a little bit about the Fed projections, noting that the latest action with Rosenstein and the Chinese espionage is different from the trade talks, but at some point they're all wrapped in all together, You can only arrest so many people and make it so many accusations without it eventually working its way in. So just keeping an eye out here. Some comments on the tick from some people. Haven't seen that about large buy programs. I'm not seeing that myself, but we'll keep a.
Well, sometimes that doesn't matter, because you're looking at a situation where if everybody's wrong-footed, and you're going to have a high tick reading without it necessarily being, a serious buy program coming in. It just could be 100,000 dissociated people all making the same decision at the same moment.
Yeah. Okay.
I mean, you get that in strong trending markets. If you got a sideways market with low volume and you get a big tick run, you've got yourself a buy program. But if you've got a aggressively trending market, you're going to get tick flushes both directions all the time, just because people are so aggressively wrapped up in what's happening.
Right. So let me ask you, Brett, what are you following since the Fed? Like, what are the markets where you're finding the most interesting working going on? Like, now, is it gold? Is it the dollar? I mean, I was kind of interested to see the dollar roll over post-Fed. Certainly gives the idea of peak tightening cycle is in play, I think.
I think policy error. I mean, I think the market is saying this could be a policy error. In other words, what it's saying is the Fed is going to have to this mistake will have to be overcompensated in terms of being rectified. Like they're wrong right now about their assessment of things, and so they're going to have an exaggerated counter response to this sooner than later when they find out that they're wrong. I think that's what the market is suggesting by that currency move. When you see overly hawkish policy shift or policy continuance or whatever, typically that strengthens the currency. When it has a dramatic opposite effect, it's usually the market saying, oh, this is an error, we're going to have to overcompensate by a swift move back in the other direction once these guys realize that they're driving toward a wall.
Okay.
I would say that's my read of what the currency markets did overnight. I mean, look at the yen.
Yeah, the yen definitely saw some safe haven buying, that's for certain.
Yeah, and even the euro is ripping on it with everything going on in Europe. I mean, even the pound is up.
Yeah.
So it's kind of, I think it's kind of that suggestion that that we're going to see. I think the market is at least preparing for the possibility that the Fed starts to, you see some Fed speakers over the next few weeks that start to come out and modify the message that we heard yesterday.
All right. You following the bonds at all? Then you seen anything of curiosity in the bonds, TLT or yields in general?
No, I mean it's just the same kind of cycle ending feel to me. It's we have no real change in the obvious macroeconomic data, and we don't have any big scare going on that's related to any particular catalyst. So yields are moving rapidly lower. We're seeing a big flattener trade across the curve, and it's not like this is because of some threat of war or something.
Right.
I mean, it's a discounting predictive mechanism in the market for changes soon to be seen in macroeconomic data, I would say.
Okay, so with all that taken into consideration, what are some of the things you'd be looking for from the Fed in the coming weeks? Do you think?
I just said.
So you think we start seeing them kind of changing their language a little bit, getting a little bit more dovish?
Yeah, I would say so.
Okay.
I think probably. I think you're going to start to see confirmation type of data. I mean, we've seen this in past cycles, right? You get to the point where, at first the message that's out there is, we've never seen such a great economy. Everything is fine. I don't know what these stupid markets are doing. And then, we start to see data that suggests, oh wait, things are starting to deteriorate in a more obvious and tangible fashion. And then, the policy changes happen. And
are you putting this on par with the ECB hike in 2007?
That was worse.
That was probably worse, right? Of course, they only had one needle, right?
I mean, God, that was just insane. So this is nowhere near on that scale. But I do believe, I believe that the cycle is dictated by, and you remember my Turtle Beach metaphor?
Oh, yeah.
Yeah. So for anybody who does not know this, the Turtle Beach metaphor is the idea that there are these turtles on a beach, literally. Just imagine a population on a beach that's just disconnected off in the metaphysical ether somewhere. But the interesting thing is that these turtles, they go in and out of their shells over time in response to the weather. So as it starts to get really stormy, all the turtles pull into their shells and they pull their legs and heads and tails in. And they wait out the storm, and then when it starts to get sunny again, they come out of their shells and they kind of play around on the beach. But the interesting thing about this situation is that the weather is actually controlled by an aggregate response to what the turtles are doing. So as the turtles all pull into their shells, the weather responds by getting worse. And so they're all in their shells, and then the weather is at its absolute worst. And if you imagine like a turtle sort of poking its nose out, then suddenly the rain lets up a little bit. A turtle sees that, sticks a leg out into the sand, then maybe a ray of sunshine pops through the clouds. Then another turtle sticks a couple legs out, and the sun comes out. And so they're responding to the weather, but the weather's also responding to them. And it's just a metaphor for how I think both the market and the economy work in terms of cyclicality. It's about risk aversion and risk acceptance. When people are avoiding risk completely, things are at their worst. But as soon as people start to take risks, things start to improve. Other people start to take risks. And this is something that permeates the banking system, the household balance sheet, how corporations behave in terms of hiring and firing and spending and investing. As people start to spend more money, corporations have to build up more inventory. They have to hire more people. That produces more incomes. The banks see that. They start to lend more money. People have more money to spend. They start to spend more. Markets work the same way in terms of exposure and the willingness to take risk, and of course that helps to fuel it because companies can do better in a market environment that's accommodating them in terms of capital raise and everything else. So the whole cycle works that way, and I think that coming into the fiscal stimulus at the end of last year and early on this year, we reached a kind of maximum of risk acceptance because like a data point that I talked about several times lately, when you look at the Class 8 machinery orders for building new trucks, that really blew up higher last November, and by comparison this November it was down year over year for the first time in like 12 years. And I think that that's a leading indicator of the sorts of things that we're going to start to see, because the way that people were behaving, we'd already progressed the cycle to the point where credit was really easy, balance sheets were really pretty thick with debt at that point, and then we got the fiscal stimulus, and then we really got some animal spirits going in the economy and in the markets. And I think that the underlying structural context for this market and this economy still wasn't great. Demographics still weren't great. Debt situation overall still wasn't great. We've got some other factors in terms of technology transitions and the way the economy is transitioning, and diversification of wealth and mobility across the economy. There's lots of structural factors that have kind of continued to be difficult on a really gigantic time frame. So in the context of that, we've had an upcycle where we exploded into risk assumption. Kind of maximized it off of fiscal stimulus in terms of how people were behaving, in terms of how businesses were behaving finally, in terms of how banks were behaving, in terms of how corporate balance sheets were behaving, in terms of how market participants were behaving. And I think we're now starting to have turtles pull in their legs and heads, and I think the weather's starting to worsen. And as the process of increasing risk aversion across the economy and the markets gradually increases, you're going to start to see more tangible and obvious signs that the weather looks worse. And if the Fed is not watching the turtles, the Fed is just watching the weather, then it's going to be reactive and slightly behind the curve as that process takes hold. And I think that's what the market is seeing right now. So the cycle, I think, progresses through a process of that sort of recursive feedback between agents in the system and the system itself as far as overriding data. So I think we're going through that process now of starting so when I look at the Amazon chart, for instance, I'm looking for a correction low, but I'm not looking for the next wave to be a new high. I think that we have maximized risk assumption for this cycle. If we're proactive, if we deal with it right, it doesn't necessarily have to be a very deep down cycle, because a lot of this is going to be year-over-year relative problems based on that kind of flourish, that kind of blossom that we saw at the end of 2017 and early 2018. And it's not necessarily going to take us to a deep, dark place like we saw in 2008, when we had a much more systemic problem, when the banks had taken on a structurally devastating kind of relationship with the real estate market and had crippled the system's heart and its circulatory system. So that's not really the case now. We've got much better controls to brace against that sort of thing, and I think we're far less likely to see that. But I'm worried about the fiscal situation, because this is also, we've passed a lot of that up the chain onto sovereign balance sheets all around the world, and that's sort of the last safety net, so we don't want to see that be a problem. But I think that we're in a process that's not just going to be a typical run-of-the-mill correction right now. I think that's the main thing. And it's going to be a process of getting to exaggerated expressions of intermediate risk aversion, where we start to see that 10-day put call head above 1.18, and if we close where we are now, we will be at the highest 10-day put call that we've seen in a long time. It'll be above 1.2, and I showed a chart several times over the last few weeks that shows what that really does. I mean, we very rarely can continue lower when we have a closing value of the 10-day put call above 1.18. It's usually a tradable low. And so we may be right on the cusp of that right now, and perhaps that's going to take us through the holidays and into early next year, and then we maybe roll back over as we start to see more tangible signs of the problems, and the Fed may be more concretely starting to shift course in response to actually seeing the bad weather, rather than just starting to notice the trend in how the turtles are behaving. So I don't know if that answers your question, but that's a bit of a tangent.
That does.
But I wanted to clarify my perspective and why I've been kind of more bearish, because I'm kind of seeing that set of factors play out.
Yeah, no, the El Tortuga Beach is always a good metaphor, too. I like it. So, out of curiosity, you seen this CME Fed Funds futures since yesterday?
I haven't looked today. Are we?
I don't see them pricing in any rate hikes in 2019.
That was yesterday morning.
In 2019.
That was yesterday morning.
Yeah.
That was yesterday morning. It was already there. So.
So I was amazed to see that, and in fact, you're starting to see growth on that January 20th of them cutting. Yeah. Which is funny, because I remember a couple months ago us having a conversation about how it was more likely that they would cut than raise rates 3 times in 2019.
Absolutely.
And it certainly seems to be playing out right now. So you wrap all this in, Brett. What are some trades that you are kind of eyeing up? I know you're just biding your time, waiting for more of this flush out. And unfortunately, it feels like we get a little bit of distortion in the markets, considering tomorrow's quarter end in an options expiration, and then of course we go into a very low volume Christmas season. I'm just looking at my week ahead that I started piecing together. I see European markets are closed. Hold on a sec. European markets. Excuse me, sorry, I just had to sneeze there. But European markets are closed Monday, Tuesday, and Wednesday for the most part. So it's going to be really tough to see how this settles, which I think kind of distorts your view and leads to a couple more question marks. Would I be right in that assumption, Brett? Or?
Well, yeah, I mean, I think we've got, especially if we close with that put call, 10-day put call at the real extreme, I think we get, kind of a throwaway bounce situation where, probably low volume, probably choppy through the holidays, and then I think that it will be interesting to see how the evolution of sentiment data, whether we start to build in, new speculative weak-handed long interest coming in, believing the idea that there's no real change in the economic data, and that this is just Wall Street throwing a temper tantrum, and it's unlocking some terrific value, and we see that kind of money move into the market, and maybe particularly during a low-volume period, and the January effect guys come in, and we kind of move forward from there and generate kind of a low volume bear market bounce situation. that hold on one second. And maybe reset the situation so that we get some sentiment data resetting, cycling back around, and then early January, mid-January. Again, my theory would be we start to see more tangible signs, more warnings coming in front of that earnings season, because this is also something that's affecting not just people on Wall Street right now. This shift in psychology, probably affecting a lot of things. So again, as the turtles start to pull into their shells, it kind of impacts the weather. And, as people start to feel like, are we, we're not too far removed from people being worried about their jobs all the time. A few years out, people may spend a little bit less, and it just kind of turns into a feedback loop, and you start to see that hit earnings, and we're often running on another leg lower. So I think it's possible that that's the sort of situation we're in at this point. But it's going to be interesting, and that I really look forward to that mid-January period as being a time where if you're in rhythm with this kind of process, then it really stands to be a very profitable period for traders.
Okay. Just keeping an eye here on Apple, which has been weaker, and I think one of the weights on the market. Looks like Qualcomm's been granted a permanent injunction against Apple in Germany. There was some rumors about that earlier, so we're seeing Apple slip down to that 150 level here. Qualcomm, for its part, also sliding low. I guess it's bad for both of them, huh, Brett?
Yep.
But so let me ask you this, and I know this is a if I'm catching off guard and you would prefer to answer this after a little bit of research, how do you view yesterday's move compared to the 2013 taper tantrum?
Completely different. I mean, and again, let's go back to that spectrum, the turtle beach spectrum, right? Risk aversion to risk acceptance. We were at a period at that point where we were just coming out of our shells a little bit. I think I even wrote a piece called Exiting the Shell at that point. But the idea that, that was an initial kind of wall of worry type of pullback, rather where there were still a ton of people who were, who had not shifted in terms of, in the real economy in terms of lending and spending and hiring, and, in markets in terms of their risk profile and their exposure profile, where they were still kind of just emerging from, all of the hits that we had taken over the previous 4 years, because it wasn't just, we think of the bottom as early 2009, but I mean, there were a series of catastrophes there for a few years, in terms of the U.S. debt downgrade and Europe blowing up twice, and we were still locked in tons of QE everywhere. We hadn't even emerged from the life support machine, and now we've been well out of the hospital and running around and having a good time, and it's just a very different context to start to see risk aversion come into the picture, because we'd already gotten to that point where we were sort of overexposed in a lot of different ways. So we're past that process of I believe maximizing that risk assumption.
All right. Okay, so I guess then that leaves us with so you're just kind of watching a tape here. You don't have any preset trades at the moment, then?
No, I'm just looking for setups, and right now the tough part is, I see a bearish pattern. I want to be short, and put call where it is just eliminates that on a systematic basis for me, unfortunately. So I can look at the beautiful setup that we had an hour and a half ago, coming out of that attempt where we had a little short time frame pattern descending triangle on the S&P after failing to rally, with that 2496 level being support and just gradually getting ground down, like that rubber ball bouncing across the table toward the edge before it rolls off.
Right.
Which is that perfect kind of technical setup.
I mean, that's basically that's basically what I was looking at when I took my short. I just kind of threw caution to the wind on the put call.
Yeah, I know that's working out for you right now. That was nice. That's where
what would change in either direction that would either get you back in on the bear side and looking a short, or perhaps flipping your thought process to the upside.
I want to see a pattern that makes me feel bullish. That's what I want right now. If I see that, I'm going to be whole hog into it, because I think we will get that face-ripping squeeze. This level of put call is unsustainable at this point. You cannot keep this kind of situation in place. I've watched this thing for 20 years, and it just doesn't work that way to me. You do not just get to 180 and just go through 2 days of downward trending with it sitting at 180. It just doesn't happen. At some point, the humidity gives way to the rain, and you get the squeeze. So it's just a question of watching for something that looks to me like a nicely defined setup. However, we've already got that level of short-term kind of market participant extreme risk aversion sitting in the tape. Now, I would expect it will be a squeeze that will not be a serious and important bottom, and eventually it will lead to some shorts when everything cycles back around and we start to get people feeling too complacent about the bottom being in, and then we're going to have some nice shorts again. It's just, but I think we're leaning too far right now in a single-minded fashion that we're going to see that squeeze at some point here before long.
All right, so there you have it then. One quick cleanup, Brett. Somebody had written in the feedback about what was the highest put-call ratio you'd seen. I think 4.2 is around the highest that I could see on the historical chart. You seen anything higher than that?
Well, so there's
back
such a
in
huge
2010, I think I saw it.
There's such a huge difference as far as what time of day you're talking about.
Right.
Because early on you can get some really skewed data, but that's a small sample size situation because it just builds throughout the day in terms of volume. And to see this late in the day, this high, I've seen higher than this, but rarely this late in the day to see something at 1.8. I've seen over 2 at this time of day, and I think that you might be talking about the flash crash, by the way.
Well,
is there a possibility that was the flash crash?
I'm trying to remember the date on the. I thought I saw February 2010. Let me see if I can pull it up here.
Hey, I'll jump in here.
March. Hey,
I'll
Scott.
jump in here. Hey, so I'm looking at a long-term chart of the put-call ratio. I don't think there's actually ever been a close above the 2 reading. I think there's been intraday movements, but I don't think as far as I can tell, going back to the charts, I'm going back to early 2000s. I don't see one over 2.
Yeah, I wouldn't imagine. When you
close.
Get that,
that's
that's what I mean, right? And that's when you've got the biggest sample size of data.
Yeah.
Obviously the most options have been most option trading decisions have been made at the end of the day when you accumulate the day. So I think as the data set gets denser and denser, it gets really tough to hold an average that high of 2 to 1. So as I said, if we close here, it's going to be pretty close to a
actually, it will be a record because why 1.7 is the record. It looks like
for the close.
Yeah. So right, and the 10-day. If you ever look at the 10-day average on that?
Yeah, I got averages on it.
Yeah. So look at the 10-day closing average. It really blow it up and look at where those moments happen where it's ever above 1.18. And I put a chart up the other day of this. It's almost always a tradable low when you get a 10-day close average put call above 1.18. It's pretty much. I don't know.
Give me 1 second here. I'm just manipulating the parameters quick. So just to verify that. So what was the number you said for the 10-day?
1.18 on the 10-day.
Okay.
Now we came close to that a couple of weeks ago, didn't we?
No, closing.
Okay.
Didn't we come
What's
close?
that?
We came close to that a couple of weeks ago, didn't we?
We did it on the 30th of October.
Okay.
And that was the low, basically. I mean, we took off to the upside from there.
Right.
18. Okay.
Yeah, and we did it again in late March, early April, and that was where we took off for that next rally.
I am showing a few of them back in 2007 time frame, but again, 2007. So, but yeah, pretty much over one. I'm just going to say 115, 118, whatever you want to say, 120ish.
Cycle. It would be the cycle high if we closed here.
Yeah, you're definitely in that environment that's considered extreme on the 10 period moving average for sure.
Actually, I see September 2015 at 1.3 on the 10-day.
Yeah, something like that.
But that was another, I think.
But that's an extreme. Yeah, I think the highest I see is like 1.3. So I wouldn't again.
Either way, we're getting very imbalanced in terms of hedging. Yeah, the people are just gone from this market to such a level that it's really tough to not rally.
I agree, but the question is, with the high volatility, you can't just dive in with both feet, not from my mentality, and just say, hey, that's it, that's the bottom, we're rallying. It's like, we can still go a little lower.
Yeah, and again, I'm talking about a bounce that I'm eventually shorting.
Yeah, exactly. Yeah, for short term. Yeah,
it's just that it's leaning too hard. It needs to reset, and then it makes it easy to short again.
Yeah, we're going to get that. I think your rip your face off rally is coming real soon. We need a higher high. If you just look back on the charts, you can get a good sense of what's going on here in December. Just a higher high has just been rejected. Pretty much all of December here. We got one on December 7th. The market tried to turn around. It got slammed. The 2 or 3 attempts that it tried to go higher, December 11th, it got gapped up and got slammed. Tried to make a higher high on the 12th, and that got slammed down. Tried to do it again yesterday ahead of the Fed, and that got slammed down. And we're just getting way too, it looks very parabolic, climatic, whatever you want to call it, exhausted to the downside. And I think that the reversal is coming soon. Whether it happens today with a big reversal bar, I just posted a comment too saying this. I see 3 scenarios. Either we're going to get this super aggressive crash-like flush down in the market, or we're going to see a very strong reversal bar where that closes near session highs, or we're going to get a gap down that culminates into a reversal of sorts.
What I would love to see is a negative headline-driven flush.
Yeah, exactly. Which would be on a
I
gap
thought
down.
I thought we might get that with some of these Mnuchin headlines, the Rosenstein headlines around China, criminal activity with the hacking, and then also no government shutdown. They were all kind of crossing, but we didn't get that flush. And I was kind of expecting to see that, which is another reason why I jumped into that short. See that put call ratio is climbed up to 185 now at the moment, for what it's worth.
Yeah, pretty crazy.
It is insane. Yeah.
All right. Well, Brett, with our discussion then, do you have anything else to add on the Fed and the fallout from here?
No, I mean, I just think it's going to be interesting to watch the process, and I mean, if I'm right, and I could be wrong about everything I said, but I feel like I feel like I understand, generally speaking, from a large macro perspective in terms of the cycle, roughly where we are, and if that perspective is correct, it's going to be interesting to see the process and how it's handled by the Fed to transition toward more accommodation of what tools they choose to use and how they deal with that. Because it's going to be every new time we go through this process, there's different factors, but now they're really not that far off the zero lower bound, and we really did kind of get to the point where I think that most people don't have a tremendous amount of faith in new quantitative easing being an important stimulus tool, and if we are really in a situation where there's just nothing that can come from the fiscal side, it almost one wonders if almost they wanted to hike just to put another arrow in the quiver, but I don't think that they're forward-looking on that, so I don't think that's what happened. But it will be interesting to see how they approach that process when we get there.
All right, Scott, you got anything for Brett?
For Brett?
Yeah.
Nah. Merry Christmas, Brett.
Hey, Merry Christmas.
I'll tell you what, while I got you guys both on, I know you have both had similar opinions on crude, so any thoughts or updates on the latest action in crude here?
I guess, it's going through that process of that capitulatory leg, and again, there's no way to say, oh, here's the line in the sand that it can't cross. It's just got to wait until it stops behaving in that mode, and it keeps on flashing to that next lower low. So there's still probably plenty of folks in there that can be shaken from that tree.
Yeah, I thought yesterday's activity was really interesting.
Well, the dollar reversal too. So I mean, that should come into it. But go ahead. Yeah, the dollar reversal is important there.
That's one thing I'm watching for sure. But then in the afternoon, it was the energy stocks that were getting hammered, and crude didn't go anywhere. Crude actually managed to hold on to the initial opening range and just kind of consolidated on an inside bar. And I just found that a little bit different from what we've been seeing a lot lately. Usually crude has been leading the way to the downside, and yesterday seemed to be a little bit more of a role reversal with the stocks themselves getting hammered. And
crude oil is not in the index.
Yeah.
If we were seeing index selling, everything gets sold, energy stocks included.
Yeah, that's true. So, but yeah, I went out there with the long in ExxonMobil. Like I said, it's at $70. It's down 15% in December alone.
What's its yield at this point?
4.5% yield. What's that, Gav?
I asked what the yield was
Yeah,
You answered it right on.
it's over 4.5% down here, and I'm just looking at the movement in this name and the activity, and I'm saying, you know what? It's ExxonMobil, multi-billion-dollar national company. If for me to own some of it down here at 70, heck, even 68, 67, I'll take it. You know, I'll take it for the next. I'll sit with it for the next 2-3 weeks. See what I can do with it. You know, maybe even longer. Who knows? But yeah.
All right, good stuff. All right, well, gentlemen, I think that should do it for this session, right? And I'm sure we'll be following this market closely over the next few days. I'll post the schedule for the audio for the holiday season shortly and stuff, but I know we'll be in sporadically, but everybody will be keeping a close eye on these markets here. But thanks both of you guys for joining me here on this discussion, and we'll be posting a taping of this shortly.
Nice. All right. Thanks, Gab.
Okay, talk to you guys soon.
Yep.